That's all I have, and I will turn it over to you, Lynn.
Thank you, Allison, and thank you for those of you who came here for the webinar and those that tuned in. We're talking our March webinar, which is January production. And we're going to really talk this month about turning 30. Lots of 30s involved here. So there's 31 days in December, 31 in January, 29 in February this year. It's all pretty close to 30. And 30, as you know, can be a difficult time in your life, at least turning 30. And amazingly, that's what's going on in the oil and gas industry in North Dakota. December production was down 30,000 barrels a day, and January production is down an additional 30,000 barrels a day. So we are truly seeing the impact of reduced activity as a result of the low prices. On top of that, our oil price for North Dakota crude is stuck below 30. We've seen a little bit of improvement of late, but we're still stuck in or below $30 a barrel. We certainly were in January, February, and it's a little bit better this month. Rig count, it was 33 at the beginning of the morning, and it's 32 now, and it's headed below 30, based on the estimates that I'm hearing from oil and gas operators and what they're planning to do with drilling rigs as we move forward into the year. Couple of other things. Natural gas storage, it's the highest I've ever seen it, 41.5% above the 5-year average. It's over 30. And flaring volume down 32 million a day. So that's in that 30 range as well. A couple of little bits of good news I think that we see in there is a little bit of strengthening of oil price, but nobody is overconfident that the oil price improvement is going to hold. Nothing really in the fundamentals has changed substantially. The agreement to freeze production is still pending, waiting on Iran. And that's really what the increase in price has been all about, or the floor. And the fundamentals have not come into balance yet in terms of supply and demand. So storage keeps going up worldwide and nationwide. I want to talk a little bit about completions. Very interesting that the completion number stayed virtually the same between December and January, and the wells waiting on completion actually stayed the same. And so we double checked that to make sure that we were reporting the correct number. This is at least what our data is showing us. There are now 702 wells in the process of being transferred from operator to operator. So that number has increased. And on the inactive side, we're up 151 wells to 1,334. Normal, that's 470 above normal. So we continue to see wells experience a mechanical failure or some type of a cost increase and go inactive. And so we're going to be working a lot on that inactive waiver process that the commission agreed to put in place. On the completion side, each company has kind of taken a different philosophy. So we've seen Whiting Petroleum and Continental and EOG come out and say we're not going to complete wells this year. Hess, on the other hand, has said we are going to complete wells this year. It's our manufacturing process philosophy. And so we're going to go ahead with completing wells. On the flaring aspect, like I said, flaring volume down, the daily volume down almost 32 million a day, and capture percentage was up. So we've gotten to 87% gas capture when you put all the wells in the bucket together. And of course, yesterday, there was a new announcement based on the visit of Prime Minister Trudeau to President Barack Obama, that they are going to jointly commit to reducing methane emission levels by 45%. So we're expecting to see some new additional EPA rules. Don't know what those are going to look like yet. There's already the rule process that they put out there December 18th of last year. That was that 4-part rule, but that was just for new wells and new facilities. So this is going to do new and existing wells and facilities. That means it's going to exactly duplicate what the BLM put out on January 22nd in terms of the venting and flaring rules that they put out. And it appears like it's all being based on some new data that EPA has just recently put out on the change in methane emission estimates from 2013 to 2014. I was in Washington, D.C. last week at EPA headquarters, and they were talking about the fact that a major part of that increase in methane emissions might just be the calculation methods they were using or the estimation methods they were using. So more to come on that subject, certainly, a lot more to come. With that, I think I'll stop talking and take questions, but it's really all about the 30s this month. The lengths of the months and the production declines and the prices and almost everything is in the 30s.
Real quick question from the webinar. Since the number of rigs has actually dropped to 32, do we have a time period when it was that low? We said March 2007, but that was 33. So
I didn't update that. I apologize. So we can get that number for you. When was the last time that it was at 32 or below? You're right. In March of 07, it was 33, which matched.
I have a feeling it was probably would be February of 07, but we'll have to check that for sure.
Perhaps.
Yeah.
Mm-hmm.
Emily?
Yeah, when you were talking about the U.S.-Canada, the forthcoming rules on methane emissions for existing oil and gas infrastructure, you mentioned the BLM rules and how they could be duplicative. Is that the right word, duplicative?
Mm-hmm.
So it seems like then you think that the new EPA rules are unnecessary or would replicate what another branch of government is already trying to do then.
Yeah, the question was my comment about duplication between possible new EPA rules and the BLM rules. I think the difference, I'll point out the difference to begin with, is that the EPA rules would apply to all oil and gas production. The BLM rules will apply only to those spacing units that have a federal well in them. So it's not exactly duplication, although I think it would make the BLM rules unnecessary and replace them, because it would do the same thing for all oil and gas wells nationwide, whether they were on state, private, or federal, whereas the BLM is doing it for only those that involve some federal minerals. So it may make that section of the BLM rules completely unnecessary.
Sticking with that same topic, any idea how much production could be impacted by these methane rules, either EPA or the BLM rules?
We haven't done that estimate yet. It's being worked on, and the reason I haven't really invested any resources into doing that calculation is that I knew the Petroleum Council has been working on that number for North Dakota, and they had sent us some initial estimates, and then they were revising them. So we're kind of waiting for them to put their numbers together, and then we'll fact check them and QC them.
Do we see North Dakota challenging methane rules for existing wells?
I'm not sure. I think we have to leave that option open as we take a look at whatever comes out. We, of course, have been all about reducing methane emissions and flaring for now almost 4 years. So we're certainly not opposed to rules that would reduce methane emissions. We'll have to take a look at how they go about it. And I'm guessing that we'll have some comments about the process or the technique that they're using and the possible unintended consequences or negative consequences in terms of oil and gas recovery. But in terms of overall opposition, I don't think we would be. And so we'll leave the option open to see whether what comments and what follow-up actions might be necessary.
Same length?
Yeah.
Okay.
How are these rules, are they different or similar to the flaring regulations that the state of North Dakota already has?
Which ones would these
I'm
rules?
sorry, the new EPA proposed rules on methane for existing facilities.
Yeah, the question was the new EPA proposed rules on existing facilities, which are, how are they similar and how are they different than North Dakota rules? And they, of course, aren't out yet. So I can't get into any specifics. I can't talk about the BLM rules, how they differ from North Dakota rules. North Dakota rules prohibit venting of gas, and so if any kind of tank emissions are going to be vented or casing head gas is going to be vented, we require it to actually be flared, to be combusted or destroyed and converted to CO2, just because methane is a very strong greenhouse gas, and it also typically, traditionally in North Dakota, has contained hydrogen sulfide or other things that would be health problems or environmental problems. So we've had a no venting rule in place for a very long time. The difference is that these rules have some very stringent maintenance and measurement and observation requirements in them, that facilities have to be monitored by some type of technology on some schedule, and there are very strict repair requirements if a methane leak is found. And we don't have anything like that in our state rules at this point. So this is being done through the Clean Air Act, and I anticipate that it's going to contain those same monitor, repair, and remonitor requirements that are in the new rule section. Where we're probably going to have some differences is in how do you handle a brand new well when you're flowing it back right after completion. How much methane are you going to be allowed to vent? For how long? In some cases there, we may find that their rules aren't stringent enough just from a safety standpoint. So there's sure going to be differences. One of our concerns with that monitor and repair requirement is the very strict requirement that if you find a leak, you've only got 15 days to repair it or shut the well down. That can be a problem in North Dakota. I mentioned to the BLM folks that we have been, quote, celebrating all week long the 1966 blizzard. And in an event or after an event or as an event like that was coming, you absolutely couldn't accomplish a 15-day repair and remeasure. So there's going to have to be some flexibility there.
Okay, we could probably talk about the the BLM flaring rule. We probably could have a separate press conference on that.
Well, we probably will. And I think when those rules come out, and by next month, we may have a whole section on that proposal. It may be a couple of months out before EPA gets rules out, but I don't think it will take them long from the standpoint that they already wrote a very detailed rule for new wells and new facilities. And I expect this one to come back with some minor changes, as this is now what we're going to do for existing wells and existing facilities. So I think we can make some predictions about what it looks like, and in a month or two, we'll be able to talk in detail.
So one of the good things we saw was flaring did drop. So how was that drop in flaring achieved, do you think?
Well, I think the primary reason for the drop in flaring was Lonesome Creek. The Lonesome Creek plant is up and running, and many of the compressor facilities that are supposed to feed that are in operation. I don't know that they're fully operational or fully running. It was good news. A lot of times, startups in January are very, very difficult. And winter weather can cause a lot of problems with gas gathering because it causes liquids to condense in the gathering lines. But we had a relatively mild January. As you saw, I think we only had 7 days that were more than 10, below minus 10. I was a little surprised when I looked back because it's been so nice. Williston actually had 3 days at minus 20. So there was some cold weather, but the primary thing was Lonesome Creek. The reason we're not higher than that is we still don't have the Tioga gas plant running at full capacity. We still don't have the Hawkeye River crossing up and running. But we're very hopeful that and the additional plants, Bear Creek and Wild Basin, are supposed to come on this year.
Let's build off the winter weather impact. Do you think that had any effect on oil production at all?
Yeah, I think it did, from the standpoint that we saw another very large increase in inactive wells. And so a lot of times that happens because there's been some type of a weather incident or a mechanical failure on the well, particularly a lot of those marginal producers in Bottineau and Renville County, Ward County, when cold weather comes around and the propane tank is empty, or we get a snow event and the road needs to be plowed, the production, especially at today's oil price, doesn't justify doing that. So we wait for snow melt, or we wait until spring and restart the well when it's not going to burn so much propane. So yes, absolutely. I think there would be some January weather factored into that 151 well increase in the active category.
Okay, here's a good question. An estimate on what each 1,000 barrel a day drop in production equates to in revenue lost. I don't think it's probably something you'd have off the top of your head, but I think it's a very interesting question and maybe something we could reply to. But thoughts on that?
Well, it's not a difficult calculation. The gross production tax plus oil extraction tax is 10%, so it equates to the equivalent of 100 barrels per day times the oil price, which today is $26.25 estimated. So you'd be talking about close to I gotta get the zeros right. $3,000, I think, $3,000 a day.
Okay.
For a 1,000 barrel a day drop. So very significant. I mean, a 30,000 barrel a day drop now, you're talking $90,000 a day in reduced revenue. One of the things that is really hard for states and local entities to deal with is that volatility. And that was one of the things that the National Governor's webinar that I was on yesterday praised, was the efforts North Dakota has made to reduce volatility in revenue collections and revenue distributions. Certainly we talked about there's some things to work on, but we're probably the best, they said, in terms of state structures in how the revenue is collected and then how it's distributed.
Okay. That magic million barrel a day question.
Mm-hmm.
If we stay below 40, or just when in general, are we going to hit that below million barrels a day?
Hmm. Well, and it, it's a psychological thing, obviously. So it isn't like a state goal or anything like that, but we're still expecting that a year from now, we will be below 1 million barrels a day. So year end, we're probably going to get there. Discussions or conversations I'm hearing amongst oil and gas producers is that February and March production declines could be equal to or greater than what we've seen in December and January. So we're losing altitude pretty rapidly.
What about rig count? If prices stay below $40 a barrel, how low do you think it could go? I feel like it's limbo here. Let the limbo stick out.
Well, we track this constantly as we see things reported in the media and as we have discussions with the oil and gas operators. Right now, the tracking method that I'm using indicates that, I think that's in here. Bear with me. I hate looking for things when I'm on video. The tracking method I'm using right now says that we're going to land at 30. But there are some conversations about some companies actually further reducing their average rig count that's based on their expected average rig count for 2016. So we could drop a little bit below 30 and then come back to a little bit above. But it's almost certain that we're going to drop 2 more rigs.
How, I'm trying to frame up a couple questions here. So is there kind of a magic price that rigs come back? And if so, how long does it take for production to rebound?
All right, very good question. Let's kind of run through the price deck and talk about where these price points are. We talked about inactive wells. And inactive wells are relatively inexpensive to put back on production. Like I said, maybe it's filling the propane tank or plowing the road or repairing a rod part or something like that. That happens between $40 and $45 a barrel WTI. So we got to get above $40 WTI for those inactive that inactive well count to start decreasing. Non-completed wells, there's a significant investment associated with that, and companies say that price point is between $50 and $55 a barrel WTI. So we're a long ways from beginning to work our way into that non-completed well inventory. Drilling rigs don't look prospective until we get above $60 a barrel WTI. And even at that, the companies are saying, first of all, they have to have a full quarter of prices at or above that price point before they feel confident that prices are going to hold and continue going up. So that means you have to have 3 months of above that price point. And then following that, they say it takes up to 12 months to raise the capital associated with that higher price. So if you've been on a very strict diet for a long period of time, it takes a while to put the weight back on. maybe not as long as it took to put it on the first time, but it takes a while. So they're saying 12 months to raise the capital to implement that new confidence. So we're talking here now 15 months or so before the rigs actually go back to work. And then once the rigs go back to work, there's an additional probably 6 months or so before that begins to impact the price curve. So it's a 2-year cycle almost. It's a 1.5 to 2 years.
What's that?
I know that the market gas price or oil prices always are fluctuating, but did you predict back a couple of years ago that it was ever going to get this low and this rig count was going to get this low?
Great question. So we all are always aware of price volatility. Did we ever predict or expect anything this low? And I'd have to say no. This one's a surprise to me, and I'm not really embarrassed by that because it's a surprise to the Saudis as well. Week before last, Al Naimi was at CERAWeek in Houston, and he said we did not expect the price to go this low. The big surprise to everybody was the Iranian nuclear and how that took the prices from their expectation, which was $50 to $60 a barrel, in that $50 WTI range, took us to 25 and 30 on the basis of that. So no. In fact, when we started the legislative session back in 2015, we were talking about $50 oil and 100 to 120 drilling rigs. And here we are today talking about $30 oil and 30 drilling rigs. So no, we did not anticipate this deep a trough or this long.
Emily, just to follow up on the lag time to raise the capital to start drilling and completing wells again, are you seeing that with hiring too? Like how long does it take to ramp up to have the personnel again to do these activities? And are companies keeping people on retainer?
Mm-hmm. Yeah, the question was a great question. We talked about the time it takes to build confidence, the time it takes to raise capital, and then the time it takes to employ and change the production curve. And I think the hiring cycle probably duplicates that quite well. What companies are doing right now, which intrigues me, is that as individuals have been laid off, the companies who plan to be here and very active at the other end of the cycle are trying to hire North Dakota residents, North Dakota citizens to replace supercommuters. There were a lot, when we were at even 180 drilling rigs a year and a half ago, there were a lot of supercommuters flying here from Hawaii and all sorts of places to work 2 weeks on and spend 2 weeks off. And so right now, there's a very active recruiting process to try to pick up North Dakota residents and put them into those jobs, so that in theory, it should be a little bit easier and quicker to pick things up than it was at the first edge of this boom. But that hiring process, I think, is going to be built into that 12-month CapEx building cycle. I think that's the 12 months that they're going to spend hiring, so that when they're actually ready to deploy rigs, they've got the people to make it go. So I don't expect an additional lag from that.
What do you think is the best guess as to what's keeping production from falling off dramatically? Is it core drilling? Is it technology? Is it different frac techniques?
I think it's a combination of those, but probably the number one reason is drilling in the core. That, you know, when we were talking a year and a half ago about how many completions it took to sustain production, that was because we had a mixture of core area wells that are 2,000 and 3,000 barrel a day wells, and wells out on the fringe that are 200 and 300 barrel a day wells. So that's probably the biggest reason. But fracture technology has improved substantially, as has artificial lift technology. So in both of those cases, they're getting better initial production rates and more sustained initial production rates. So I think when we take a look at, say, 6 months from now, and especially after the Williston Basin Conference, when we take a look at what companies have done to flatten that first-year decline, we're going to see some really significant technology changes that I don't think that initial 1 year decline is 65% anymore. I think it's flatter than that.
And of course, we hope you all consider coming to the Williston Basin Petroleum Conference, because there'll be a lot of technological advancements discussed there. So please keep that in your mind. It's March, I should know this, May
24, 25, 26.
Yeah, in Bismarck. So
here at the event center.
Please consider coming to that. We've got time for a couple more questions. Building off the hiring question, do you think there's actually hiring going on right now, or are they just kind of headhunting? What's going on there?
Some of the folks I visited with in Houston indicated that there's actual hiring going on right now. For example, we had one of our bigger Bakken operators who just recently let go a little over 50 people. And those 50 people were involved in the fracking part of their business. They had their own frack crews. Well, they're North Dakota residents, and so one of the big service companies is actually hiring those guys to replace commuters, people that were coming in and out of the Little Missouri or Little Muddy Lodge. They want to replace those folks with some of the 50 that were let go. So yeah, there are active hiring processes ongoing by several of the companies, particularly the service companies.
And the last question that I have here, you talked a little bit about wells waiting for transfer. Do you think there's going to be more of that, or have we passed that peak of distressed transactions?
No, I think there's going to be a lot more of that. We're coming up on the June debt redetermination deadline. And, you know, we haven't seen the announcements yet. We kind of wait every month, and we expect it, but there's going to be more companies that have to get out. And so we're going to see significantly more. And interestingly enough, some people that I met with in Houston are raising money right now with the anticipation of being there to make those acquisitions. Okay,
I've got 30 seconds technically left. So
Ben's got a question.
Okay, Ben, I cut you off last time, so yeah, we'll let you
don't do that.
I'm ready now.
Okay.
So last month we talked about oil storage being at like the highest level since like 30s. Now we've got high natural gas storage, but has our oil storage levels gone down at all this month?
Great question. The question was about oil storage last month being at record levels, and has it gone down? And it has not. It actually increased, and they continue to build storage. One of the interesting paradigms that we're seeing is that these DOT 111 tank cars that are no longer acceptable for moving crude oil are actually being used in some places for temporary oil storage. So we're seeing them parked on rail loops at end destination facilities and filled with crude oil. So they're not being used to move the crude oil, but they're being used to store stable crude oil. So no, oil storage continues to go up. And that's one of the things that I talk about is there's just nothing really in the fundamentals to say that this price should be increasing. It should stay about here for a while.
Okay, well, we have reached our time limit, so, did you?
Oh, I was just kind of following up on hers quick. I was just kind of curious as to, I guess, how did nobody realize that things could drop the way they did with, everybody drilling as much as they could for the last few years? Didn't anybody kind of realize that after a certain point, the supply would exceed demand? It just seems like a really basic kind of concept, and I'm just kind of surprised that no one would have realized that at some point.
Yeah, the question was,
how did nobody know?
How did people miss the signal here? How did nobody know what was coming? And we had some of that discussion yesterday. In fact, the guy with the National Governors Association asked that question, and we gave 3 different answers about all of which we all agreed that all 3 points were accurate. Probably the first one is that whenever a new technology or a new discovery is put into play, industry tends to way oversupply the market. So we saw that in the 1980s when 3D seismic was invented, and it changed U.S. onshore drilling and really worldwide. We saw it again in the 90s when subsalt and deep water technology became available. The market overshot the supply-demand curve. And now here we are with shale oil. We did the same thing. It was kind of invented here in the Bakken, and then it went to the Eagle Ford and the Permian and Argentina and really overshot the market. And the industry and us prognosticators are terrible at actually estimating how much that's going to impact. The second big factor is that as companies make these investments and employ this capital, the initial investment in the wells is very high, but the cost to continue production is very low. And so they tend to continue producing their wells at maximum rate, even as the price goes down in an attempt to recover that capital. And so that tends to exacerbate it. And then finally, we did get some surprises. The amount of oil on the black market and the lifting of the Iranian sanctions were complete surprises to the market and shocked everybody. So everyone thought we would settle into a $50 price range, weather our way through that. I should throw in one more factor, and that's the major slowdown in the Chinese economy. But this crude oil supply demand thing is notorious for oversupply and undersupply. And it just, I guess we don't have the tools figured out yet.
Okay. It's Kringstad. Switch it up there.
Big news.
We did? Okay. Are you sure he's up? Just kidding.
There we go. Okay. Perfect. Well, good morning, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. I'll work through my standard update on the different areas of the production and midstream industries. Wrapping up 2015, you can see the basin-wide totals on page 2. Again, you will notice production slides, not only in North Dakota that we've been discussing, but eastern Montana, South Dakota as well. So that total production for the Williston Basin has continued to slide in neighboring states as well. And then just slide 3, the updated North Dakota production for 2016. On the overall transportation of that crude oil to market, again, some additional shifts with additional market share going towards the pipelines versus the rail. You'll see on slide 5, again, one of the major driving factors, I talk about it every month, is that Brent versus WTI pricing. And you will notice that in January, WTI was actually at a slight premium to Brent. And so we have not seen that for many years. And again, you can see the trend lines as that premium was realized on WTI, following trends with more barrels being attracted to pipeline markets versus the coastal refining centers. My estimated rail volumes for the state continue to move downward. For January, it's estimated to be right around 500,000 barrels of oil per day leaving by rail car. Slide 7, no major shifts really on the overall destinations of these crude oil barrels. Again, that's driven by price at these different refining centers, as well as the ability for those refining centers to take in trains and have contracts for those deliveries. When we look at prices on slide 8, this was as of December. It's the most recent available from the EIA. But again, you can see PADD 1 on the East Coast having the highest priced refiner acquisition cost, followed by the West Coast and the Gulf Coast. I've been using this same slide, but updating each month for quite some time now. A year or two ago, we would have seen much larger price disparities between that PADD 2 and some of those coastal refining areas. And so again, that is driving some of those transportation decisions on where a barrel gets placed and at what price will it receive at that destination. And then as we sit here, this was as of yesterday afternoon, just over a $2 spread between Brent and WTI. So no major shifts. I don't expect any major transportation market shifts here in the near term, because we still see that very tight spread between Brent and WTI pricing. Crude oil imports, exports across the Canadian border with North Dakota, still seeing relatively high amounts of crude oil coming into the state, and exports moving up into Canada has stayed fairly steady. So we'll continue to watch this. These all get accounted for in those estimates of rail movements and market shares by transportation type. On the flaring side, again, as Lynn alluded to, 87% capture. We saw a 1% decrease in that orange piece of the pie. Again, those wells that just didn't have enough pipeline capacity to move all their gas. And so Lynn alluded to not only gas processing, but additional compressor stations that are being built, and different steps that the companies are taking to try and debottleneck these systems, try and move as many molecules of natural gas through those gathering pipelines as possible. So that's going to be an ongoing effort, along with, at the same time, on slide 12, getting new wells connected, but really trying to stay on top of the existing infrastructure to make sure that it can handle all the wells that are being connected, so those molecules can get to a plant and then get sent to consumers. And then slide 12, just an update on how many wells we're getting connected to gas gathering systems versus how many were completed. Again, new wells selling gas was outpacing the new wells that were producing gas. And so that's, again, good news that they're keeping up and staying ahead of the drilling activity with well connections. So that wraps up the formal comments. I will note that yesterday, many of you are probably aware that the Dakota Access Pipeline did receive unanimous approval in the state of Iowa for siting in that state, and so that it was the last state remaining for that pipeline route from North Dakota to Patoka, Illinois. And so the intentions at this point, from my understanding, is that the company will begin construction with the goal of having that system in service late this year. And so it would require multiple spreads working on that pipeline route in order to make sure that they meet that deadline. But again, all anticipations are that that system would be up and in service by the end of the year at 450,000 barrels a day of capacity. Further expandable in the future should market conditions exist to do so. So,
Of course, the natural question is, what will that have on Bakken producers? What impact, now that that's been approved, are they going to be able to get a better price if they ship by pipe instead of rail?
yeah, and so, even what trying to answer the question a couple different ways. Here recently, we've seen that prices are such that pipelines in today's market are the most attractive option economically. It's going to all depend when the system goes into service, what market conditions look like. So it's tough to put a dollar amount that when this line goes into service, it's going to have X dollar impact on the producers in North Dakota. It will be a positive move because we have seen historically that as North Dakota has higher levels of pipeline connections to higher priced markets, that pricing at the wellhead improves. So I do expect this to have a positive impact on pricing, but to try and put some kind of dollar figure on it, I think would be incredibly difficult, if not impossible to do.
Do you know how many barrels are committed to Dakota Access so far?
I don't. The number of barrels, that's all kept private by the companies and the shippers using those systems.
Is the route like 100% decided for North Dakota?
The question was, has the route been 100% decided? That'd probably be a PSC question. If there were any variations that were coming back to their office, that I can't answer without having their input from the commission if they're seeing any type of route variances. So, but it was approved, as heard in their case for the citing of it.
So this is a good question, but I don't know how much detail you go into. If a company has committed to Sandpiper, say, and obviously Sandpiper is having problems in Minnesota, could a producer then switch their commitments to Dakota Access?
As far as what, so if a shipper or someone that had oil to move and they were anticipating Sandpiper being in service in 2017, and now with it being delayed till 2019, yes, they will have to find something to do with those barrels. So they will find an alternative transportation method. Whether or not they would try and get some kind of commitment on a different pipeline system or use spot or open access on that pipeline system, that would be, independent of each shipper and what their choices are. So that's a difficult one to answer. But typically with a pipeline system, when they look for shipper commitments, everyone's different, but it may be longer terms, 5-year terms, 10-year terms, for certain barrel amounts that need to get delivered. So, they could probably work out some kind of agreement. I'm not sure, but that would be up to those companies to decide.
What do you think the impact will be on crude by rail movements out of North Dakota of having Dakota Access be built?
Yep. So the question was, what does Dakota Access mean for the share of crude oil that leaves currently by rail? And so there will be a definite shift. Those barrels that will be moving on Dakota Access would currently be moving on some other transportation method. With market conditions the way they are today, all things point that we would see a significant reduction in rail movements, that those barrels would choose the pipeline destinations and would be filling up the pipeline systems to move to those more attractive destinations.
Just to follow up, even though Dakota Access isn't going to the East Coast?
Correct. And so, as we sit, so the question was with the destination of the Dakota Access and how that ties into pricing. So Dakota Access primarily would tie North Dakota down to the Gulf Coast. This would be the first major system that would provide high levels of production and move from North Dakota directly to the Gulf Coast refining centers. And as we see the prices where they sit today and the pipeline option now to get to the Gulf Coast, in today's market, in my opinion, that would be a more attractive option than trying to get to one of the coastal areas, assuming that barrel is not committed to one place or the other. Then it really isn't even a question at that point. If it's a committed barrel, it's going to move to wherever it's committed. But if it does have the flexibility, we have seen in the data, the trends are that they're moving to the more traditional pipeline markets.
Question. Do you have one more thing?
I'm not sure if we'll be able to answer this, but say when the project's completed by the end of the year and we're expecting production to go down as well, and the Dakota Access will make up 450,000 barrels per day, but then what if our production's at 800,000? How is that gonna play into all the other pipelines and everything else?
Right, so that's a great question. So the question for those on the webinar, you know, with some uncertainties where production's going to be, you know, when you bring on a large system like this, what happens to the overall transportation network? So that's a big uncertainty where production will be. You know, we've got our forecasts, and you heard Lynn talk about that 1 million barrels a day potentially. And so with decreasing amount of production and increasing pipeline capacity, again, I would say that all indicators point to more and more barrels shifting onto the pipeline systems versus the rail outlet option.
Okay. All right. If there's no other questions, we will call it a webinar. And thanks everyone for joining us. And that's all. Thanks.
Okay, thank you.